Well, welcome to the Pool Chasers podcast. I'm your host, Greg Viafania, joined by my co-host, Justin, the bearded plumber Bowie.
That's right.
And today, we've got two very special guests. We got Garth Stevens and returning guest, Buzz Ghiz. How you guys doing?
Doing well.
Doing well. Thanks for having us.
Yeah, dude. Your episode did so well with us, and thank you for introducing us to Garth. And we've got some really cool topics to go over today, so really excited to jump into it.
Absolutely. Thank you both for coming.
Yeah, thank you.
Yeah.
So Garth, you're new to this show. Can you introduce yourself to the listeners? Maybe like a quick bio and how you know Buzz.
Sure, absolutely. So Garth Stevens, I'm a corporate attorney. A sizable part of my work is M&A or mergers and acquisitions, which is fancy talk for I help people buy and sell companies. Been doing it for about, I think I just passed 28 years. 23 of that here in Phoenix at Snell Wilmer, which is a large law firm downtown. A lot of the work I do is what you would call sell-side deal work, meaning you're representing the sellers of the business. And those deals, they range in all sorts of sizes from relatively small up into north of $100 million. But a typical, what we call a middle market deal is somewhere, let's say, in the $25 to $75 million range.
In the business revenue, is that what we're talking?
In the purchase price. Actually.
Oh, purchase price.
Yeah,
okay.
Yeah. But smaller deals too, and larger ones. Most of the aspects of the sale transaction doesn't differ that much, so I don't tend to focus too much on dollar value of the deal value because the work is largely the same. The issues are largely the same.
Sure.
I got to know Buzz, back in something like 2004, I think it was. Another partner in our firm was doing work for Buzz and his family, and they were getting ready to sell Padock Pools back then. So I was the lucky guy that got tapped to do that, and worked with Buzz and his family all through that, successfully sold the business. We've stayed in touch over the years, doing a handful of things, and then, I don't know, how many years back now? Was it 4?
I got close in August of 18. So
18, okay.
Yeah.
So then we sold Paramount. So I got a second kick at the can to work with Buzz, and always a good time.
So first one must have gone good if he called you back again, right?
I guess so, yeah.
and many calls in between, by the way. for
Okay.
Lots of my deals.
Fair.
Yeah.
Were you feeling like you hit the jackpot? Like you just keep hitting them up? Like, hey, you got anything else to sell? Any other crazy businesses?
I got to tell you, I've been very lucky over the years. In almost all cases, I always really like the clients I work with, and it makes such a difference. It makes the job enjoyable.
That's awesome. Was Buzz your first pool-related merger, acquisition, sale?
Yeah, actually, yeah, he was. So learned lots about the pool business.
Nice. Yeah. And I know we can't say names, but you've represented some other big pool industry deals too, right?
Yeah, and all on the sell side. So in Arizona, California, and I guess I had a couple brewing in Texas and one back east that are sort of slowly in the works. But yeah, I've done a number of them now.
So I guess kind of jumping into it, what are some of the structures that you can set up when you're selling your business, or what kind of deals can you ask for? Or can you kind of run us through what that looks like?
Sure. Typically, pool deals are run one of two ways, and there's possibly a third option. One is what's referred to as an asset purchase deal, and that's where the company itself, so XYZ Pool Company, is selling its assets, it's selling its customers, its equipment, it's going to transfer its employees over, assuming those employees want to go over to the buyer. And so that's sort of deal type number one. Buyers typically like that structure because any of the sort of residual liabilities or potential skeletons in the closet, potential environmental issues, what have you, they will stay with the seller company. The next structure is referred to often as a stock purchase, or it's an equity purchase deal. Nowadays, many companies are LLCs, so they don't have stock. In an equity purchase deal, the owners of the company are the sellers, and the company itself is being sold. So rather than having to transfer over the trucks or the equipment, whatever else, the whole company goes lock, stock, and barrel to the buyer. There's added risk to the buyer with that because the buyer is buying everything that comes with that company, whether they know about it or not. And there's tax advantages and benefits of each structure. Those things tend to get sorted out pretty quickly. The third approach you see sometimes more with companies that have multiple numbers of shareholders is a merger transaction. And that's where sometimes it can just be difficult. If you've got, say, 10, 15 owners of a company, trying to get them all in the process of negotiating the purchase agreement and selling it can be a bit of an exercise in herding cats. So a merger transaction is structured, it's still considered an equity sale, but it's a deal between the target company itself and the buyer. So you need to get typically majority owner approval, but you don't have to get every single owner to sign up on the deal.
I see. I get these emails all the time. As a business owner, you get hit by everybody, right? I get these emails and it's always like chips off the table. And it's like, keep your business, but take some chips off the table.
Sure.
What is that? What is that?
You hear that typically nowadays where let me back up. The vast majority of buyers nowadays are private equity firms. Or they are private equity firms that have bought another, say, pool company that wants to sort of acquire another pool company as what's referred to as a bolt-on transaction. That's sort of a colloquialism in that business. But typically when private equity firms buy companies, instead of saying we're going to buy 100% of your company or 100% of your assets and here's your cash and off you go, they'll want the seller to stick around and retain around, usually it's around a 15 to 20% ownership interest. So when we talk about, take some of your chips off the table, what they're saying to the owner is, you can sell us effectively 80, 85% of the company. You retain ownership of 15, 20%. And then later, when we, the private equity firm, resell your company, because that's what private equity firms do. They buy these companies with a view to reselling them, say, around 5 years down the road. The company, if everything goes according to plan, these private equity firms, when they do this, the idea is to triple the value of the company in about 5 years. So the owner who has retained his 15, 20% will then sell when the private equity firm sells. And by that time, their 15, 20%, again, if all goes according to plan, is worth 3 times more than when they originally sold the company.
I see. Interesting. I see.
So as the seller, what are some things that you should ask for?
You're talking just at the beginning of the negotiation?
Yeah.
Well, the most important thing obviously is price. And it's important for sellers to know what their company's worth. Everybody wants to believe that their company's a great company, worth a ton, but
how do you go about figuring out the evaluation of your business?
You should ideally, if you've got a good accountant, work with your accountant. If your accountant really doesn't get valuation, some of these smaller companies, they've got an accountant that really knows QuickBooks or something, but beyond that, they're not going to handle things like what's referred to as quality of earnings. So you'll want to work with a sophisticated accounting firm or a business valuation firm that can give you that information in advance and give you a sense of what you think a buyer would pay. Because you want to go in with a sense of reality, right? If you go in thinking my company's worth $30 million and a buyer tells you after they've kicked the tires it's really only worth 15, you don't want to have invested a bunch of time, effort, and money going down the path of a deal only to pull out because it's not going to get you what you thought.
That makes sense.
How do you measure what your marketing is worth? So if you have, you're powerful on, say, Yelp and Nextdoor, and you're ranking on the first page, does none of that really matter? It's all about like what traffic is actually being turned into like money in the business. Like, how did they put a dollar amount on what your marketing is like? Because
it's a really good question. It's a hard one for me because you're really getting more into the valuation side, which is not what I do. And of course, with a pool business, it's not really recurring customer business. You're not selling DVDs where a person's going to keep coming back to buy more DVDs. Once someone's bought a pool, unless they go buy a new home or something, they're probably not coming back to you for another pool. So I would think kind of your back order duration would be a big factor on how successfully. If you're sort of doing a subsistence amount of advertising where you're just bringing in enough work to keep your employees employed, but you have no visibility over, say, 90 days out, probably not that great. If you're out there, you're regularly marketing, selling, and you've got a 1 year or 18 month or 24 month back order, backlog, that's going to be a good sign. But generally, businesses are bought and sold, or I should say valued, based on their EBITDA. So
what is EBITDA?
Earnings before interest, taxes, depreciation, and amortization. So it's kind of a funny concept when you think about it, because it's what are your earnings, so what are your profits, but let's exclude all these things that would actually cut into your profits, right? So it's not really truly your profitability, but companies that buy other companies or private equity firms, they typically measure companies based on what's called a multiple of EBITDA, meaning they'll pay anywhere from 4 to 10 times what a company's annual EBITDA is. And that's then what's referred to typically as the enterprise value of the company, and that's where your purchase price is going to come from.
Let me just jump in just a little bit on the marketing side. I do think it does weigh a little bit as it relates to having a well-run business to make sure that you're doing a good job on the marketing side and you've got a good reputation out there. I think that's where you can kind of inch up the value in your business, and I definitely it's based on your EBITDA, but it's all about how well you run your business. And I think the other very important thing is the staff that you have. Make sure that your key people are key, because they're going to look for that in that business to make sure that if the owner gets hit by a bus tomorrow, that business can go on. So surrounding yourself by great people and that can run the business and running a well-run business with marketing, it's important. Again, it doesn't weigh way up on the scale, but it's an important part of running a business.
Yeah, well, that's going to keep your business being consistent. If you're being proactive with marketing, is if you have good team, good leadership, and you're growing and you're doing all the right things. Because we've seen it before where these companies are growing really fast, great brand, but they have bad leadership and they go down quick. It's like they had a big investment and they're done.
Well, or the flip side of that is you have a company that's really well run, but it's run by one individual, one key person, and which, by the way, is also the reason that these private equity firms often want to have these people stay with the company, because private equity firms, they're financial engineers, they're finance companies, they're not operators. So they need the people that have built these companies and made them successful to stick around at least for some period of time to do that. But one of the concerns they will have is if they look at a company and they say, this is a great company, but they say, using Buzz for an example, if Buzz gets hit by a bus the day after closing, this company's toast, because Buzz is the company. So one of the things they're looking for is depth of management, succession plan, something that means that the company is more than just the founder.
Yeah. How do you demonstrate that? Like, how do you demonstrate that your key employees can run the company without you?
Well, qualification of your management team, how long they've been with the company. A buyer will absolutely, at the right time, when concerns about confidentiality have passed, but they'll want to have discussions with members of the top management. They'll want to have a sense of, can number 2 step in and become number 1?
Mm-hmm. Yeah, they do a lot of interviewing, I will tell you.
Is that right?
Absolutely, they do. Yeah.
So how much did you learn about your business with Padock when you were going through that transition of selling the business and they were interviewing some of your key people? Because I have to imagine that, as close as you are to the business, you had to have learned some things like, oh, I didn't know that about them, or
about the key personnel,
about the people,
yeah,
like the managers below you or whatever.
I think I was so close to it. I'm such a hands-on guy. I didn't learn much about it. I knew what each one, the skill set was and what they could bring to the table and what they did bring to the table. So it wasn't really that people wasn't a learning curve for me. What was a learning curve for me on the Padock deal, and I learned so much in between the Padock and the other transactions I've done, is you have to be prepared for a sale. You just, other than getting lucky and someone knocking on the door, but usually it's a process, and I know you're going to talk about it a little bit, but maybe 2 or 3 years of getting your business prepared for sale and doing the right things, because it'll help your valuation big time when you do that. And I think that's what I learned most about. If I were to rewind things, I might have said, let's wait a couple of years, let's do this. Consult with people like Josh that you've talked to and Garth, and how do I get my business so I can get the greatest value for it? It happened so quickly at that time. I think that's the biggest thing that I learned. I didn't learn too much about the people. I knew them so close. It was such a tight family knit business that I knew each one really well and what they could do and not do.
Sure.
I want to go back really quick. I have, in the first 2 scenarios, you said the asset purchase, right? Can you break those down one more time?
Sure.
The 2, because I just want to make sure I got it.
Yeah, think of it this way. In an asset purchase, your company is the seller.
Okay.
It's selling its assets. In the stock,
Trucks, everything.
everything.
Okay.
File cabinets, trucks, concrete supply,
Building, if you got it.
contracts, all the stuff, all the assets that are used to operate the business.
Okay.
And typically the buyer will assume, and by the way, that includes like your accounts receivable.
Okay.
And the flip side is that the buyer will assume your accounts payable.
Okay.
Okay. Now, in an asset purchase deal, the seller keeps their cash and their bank accounts typically. So that's not going. So again, think of in an asset sale, the company itself is the seller. In a stock sale, again, equity sale, the owners of the company are the sellers, and they're actually selling the company. So everything that's in the company just automatically goes with the company.
Bank accounts, same thing. I mean, buildings, trucks, everything.
Yeah. Now, one thing maybe this might get a little technical, but there are some adjustments to the purchase price in a deal. And cash and debt, you'll often hear the term, it's going to be a cash-free, debt-free deal. And what that means is, and it's more pertinent in a stock purchase deal, is let's just say the purchase price is $20 million. Okay, if the company on the closing date has $1 million of debt, well, the buyer, they've just bought $1 million of debt. They don't really want that, right? So they say, well, we're going to reduce the purchase price by $1 million, or we're going to take $1 million, and instead of paying you that 20, we're going to pay you 19, and we're going to pay $1 million to the bank to pay off that debt. Okay, so call that the downside. But the upside is, suppose you have $2 million of cash in your bank account. Well, you're going to get paid dollar for dollar for that cash. So now instead of, you started at 20 and you had $1 million of debt, so that brought you into 19, but you got $2 million of cash, so you're up to 21 now.
I see.
Okay, so in an asset purchase deal, you don't typically have to deal with that because the buyer is not going to assume your debt and they're not going to take your cash. So it ends up being a wash. Either way, you get effectively the same result.
I see.
But yeah.
Okay. Just wanted to make sure I understood that.
It's a lot of moving parts.
There are.
Garth, aside from taxes, is there a better way for someone to look to sell a business? Is it best asset, tax aside from an asset or stock? I know that what we did at ours, but
Sure.
how do you consult someone and tell them that, hey, this is the best route to go down?
Sure. Well, if you're on this, there are reasons to do it to choose one approach or the other on the buy side, but I'll stick with the sell side because I think that's what we're talking about. So I'd say there's a number of things. One is simplicity. Simply, stock sales are simple. When it's time to sell the company, you sign a piece of paper that says, I'm assigning over my stock or my LLC membership. Here you go. I don't have to convey the real property if the company owns real property. I don't have to sign over vehicle titles. I don't have to terminate my employees and have you, the buyer, hire them. All that stuff just comes with the company. So simplicity is a big standpoint. One of the areas that can be of concern is if a company has key permits or key contracts, and in either of those cases, under the terms, it says you need the consent of the permit issuer, or you need the consent of client number one in order to assign this contract, this permit. You've got to go and get that consent as a condition of being able to get that deal done. But with a change of ownership, most of the time, there is not a consent requirement. So again, from the simplicity angle, sometimes it's just easier to do a stock deal or an equity sale than an asset sale. The second one is, and you touched on it, is tax. And tax will absolutely drive deal structure. There are tax advantages and disadvantages of each side. It really depends on what type of entity the company that you're selling is. So if you're a C corporation or excuse me, an S corporation or an LLC, partnership, that's going to have an effect on how the proceeds that you collect gets distributed. So for example, a C corporation, which is your traditional good old-fashioned corporation, if it is the seller in an asset sale, it will get taxed on its profits, on its gain from the sale. And then when it wants to distribute those net proceeds up to the shareholders, there'll be a second tax on the dividends. Same way it works if the company's earning profits during the year, 2 levels of taxation. In an equity sale, the sellers are directly selling their ownership interest. So they will pay income tax on their gain, but that's only a one-time tax. Now, sometimes the combined double tax isn't that far off of a single tax. So it depends on tax rates, structure. There's certain cases where the buyer will want to, and again, this will get way too technical probably for this discussion, they'll be willing to do a stock purchase, an equity purchase, provided that they can make certain elections that allow them to treat it as an asset purchase, which gives them step up in basis for added depreciation and some other advantages. So there's different ways to skin that cat. But again, that's why it's very important that the seller is working with a knowledgeable accountant to help them understand that.
I was gonna say, it sounds like you really got to have the right guy.
Absolutely, yeah, you do.
Are you allowed to change the business structure to, I don't know, a better structure to sell your business?
Oh.
Say you're an LLC and you need to change to like a C Corp or an S Corp. Have people done that? Or does that look sketchy to the buyer?
No, not at all. I mean, anything like that is going to be disclosed to the buyer. And usually, again, if the company owner, the seller is getting good advice, they're not going to do anything without putting the right amount of thought into it, including in terms of A, it's not going to have any adverse tax consequences on the seller themselves, and B, it's not going to do something that's going to make the company less palatable to the buyer. But in fact, it's pretty common nowadays in deals that I do where there will actually be some kind of a tax-related reorganization done as a preliminary step in getting the deal done. So yeah, just because your particular structure now is what it is doesn't mean you can't change it. With that said, there are certain things that a person on the seller side might want to do, but you have to do that with a certain amount of time in advance. So it's not something that can be left to a day before closing or even a month before closing. It may be something they need to start putting into place years before closing.
So who would maybe make that suggestion? Would it be you or the accountant?
Typically, early on in that phase, it's really more the accountant. So for instance, if let's say a seller is saying, look, this is a C corporation and I'm going to get this tax hit. What can I do to reduce this? And that's what you work with the accountant. Another one may be, I'm a seller and whatever my deal structure is, I'm going to make this big gain, which is going to be taxable at my higher rate of tax. And I've got some kids. I'd like to channel some of this, gain from some profit to start them off in life, and they'll be taxed, but at a lower tax rate based on their income levels. How can I do that? And again, that's something that, things like that can be done, but there needs to be some runway in advance to do that properly.
How long does it usually take from negotiation to close on a deal?
I'd say on average, you're talking about 3 to 4 months.
That's fast.
Yeah, that's faster than I
well,
thought.
I mean, and it can take longer. I mean, if you've got a motivated seller and a motivated buyer and good advisors on both sides of the deal, the advisors know how the process works, and they'll kind of shepherd and sometimes push the clients through. But it's the process itself. 3 to 4 would be, I wouldn't say, at least by my experience, not fast, but it would be somewhat expedited. You want to say 5 months on average, that'd be about right.
I would think there'd be a ton of back and forth negotiations, but it's not too bad.
The way it works typically is the first stage of the negotiation is the parties work out sort of a non-binding agreement, sort of what's commonly called a letter of intent. And that's going to set out the basic terms, which is going to say, we're going to do a stock deal. The purchase price is going to be X. We're going to expect the seller to retain 20% ownership, and he's going to get an employment agreement. We want him there for at least 3 years, and you'll have the stuff. And then the buyer will start. And that, by the way, that agreement will have been made with the buyer having been given some amount of information to help them understand the company and what it's worth. But then they're really going to drill down and do their due diligence. And then during that process is when the lawyers typically get more involved and are actively negotiating the purchase agreement and a bunch of the other ancillary agreements. And that process, runs often right up through to the closing. So it's a lengthy process. And as Buzz can attest, for the owners, the operators of the business, they're busy running their business. So they've got all of the pressure of the work of running their business on top of all the work that goes into negotiating and papering up these deals.
Justin, I just want to say one thing you brought up, and Garth brought it up a couple of times too. I think that one of the best advice we can give, or I can give to someone that's looking to sell their business, is surround yourself by professionals. Too many times people don't do that. They try to do it themselves, or they try to just get their accountant within their business. Get yourself a crackerjack M&A lawyer. Get yourself a crackerjack. What do we call Josh? A financial advisor?
Oh, he's a CPA, an accountant.
CPA, and then within his firm, he's got a who does the selling of the businesses.
Well, they have M&A. They have different terms: M&A advisor, investment banker.
Investment bankers.
Yeah.
I just stress it among the people that I've talked to, and I've helped 3 or 4 of them too at different stages. Is make sure you surround yourself by the right people. It'll save you time, effort, and not only that, it'll maximize your value to the business. But so too many try to do it themselves, or using people that aren't qualified to do it. Big mistake.
Seems like you'd just get screwed.
Well, you can, or you're not going to get to maximize the value out of your business, or you're going to be. I mean, how many times we go round and round with the Paramount deal? I mean, on the phone many times, and it's just and it's a good buffer. By the way, the owner let Garth be the bad guy, or let Garth do that, and I can kind of stay, because it's an emotional process too. I will say something else. It's very, for me anyway, I will tell you, both sales. It's an emotional time. I mean, from the Padock side, it was my dad started the business in 1958, so it was the emotional having that part of it. Am I doing the right thing for my dad, what he did, and of course with the Paramount that I started, and it was my baby, and it's a tough. So got to get through that emotional side too.
Yeah, I can remember on the Paramount, gosh, when we were just sort of days from closing and having a conversation with you, and you were having some deep second thoughts.
Yeah.
But yeah.
He said, yeah.
But
Sure was.
But if I can just add on the advisor kind of comment, and I'm not saying this just as a pitch for me. I mean, people should pick whoever they want to pick with, but you absolutely want to have competent legal counsel, competent accountants. I've been on a number of deals, for instance, when I'm on the buy side, so I'm representing a buyer, and the legal counsel on the other side, who might be very pleasant to work with, but they're just so completely out of their element. And it's not my job to protect them or their client. Now, I'm not going to play sneaky games with them or anything, but there will be things in the deal that I would ordinarily get pushback on and would be more heavily negotiated if they had good legal counsel on the other side. And they're not picking this stuff up.
Wow.
And I have a client, a serial acquire client I was just dealing with today, and we're starting up a new deal, not in the pool business, but we've done 15 deals together probably in the last 3 years, and he knows my system, and he knows I want to work with a good lawyer on the other side. I don't want to be dealing with someone who doesn't know what they're doing. It makes the job harder for everybody. So here's a buyer client who's telling the other side, go get yourself a good lawyer. Don't just use your solo family lawyer you've used for the last 15 years. That's not the person you want on a project like this.
So when should you engage an attorney or a financial advisor, or I don't know, maybe you can list some other people, because there's probably quite a few individuals that are that help with this deal.
Yeah, I mean, the 3 main ones, which we've already talked a little bit, there's your qualified accountant, a qualified attorney, and then an M&A advisor or investment banker. There's different terms we use for those, and I'll come back to that third one. That one may or may not be necessary depending on the circumstances. But very early on, once you're thinking you're going to go down a sale path, you want to be working with a good accountant, like I said earlier, who's going to help you get an understanding of what the value of your business is. B is going to help you really clean up your financial statements. Most family-owned companies or smaller companies don't have audited financial statements. Most don't even have what's called reviewed financial statements, which are one sort of step below an audit, but still have been sampled and looked at by an accounting firm. A lot of businesses just operate on something like QuickBooks or some version of that. And there's nothing wrong with that. It works for the business, but when it comes time to sell, a buyer is really going to want to drill down into the company's financial statements. And the financial statements have to be in a decent enough condition that a buyer can make heads or tails of them at a bare minimum, but also you want the buyer to have confidence that the seller understands how to account for their business, their financial dealings. So, it's important to work with an accountant helping you make sure those are in proper order, that they will be presentable. And then as well, that accountant will be advising, like we talked about, is your company in the current structure right now? Are there things that can be done, to tee up the company for a sale? In terms of working with legal counsel, the earlier the better. One of the issues I've seen is we talked a few minutes ago about a letter of intent as an initial stage in a negotiation, which again, it's a non-binding document, but it does set out sort of what the parties have agreed in principle as to what the deal terms are going to be. And too often, more than to my liking, a client or a new client will come to me saying, hey, I've got a signed letter of intent. Let's start working on the deal. And I'll look at that letter of intent and I'll go, ugh, I wish you really hadn't agreed to that particular term. Or what does this term mean? And the client goes, I don't really know. I figured we'd just sort that out when it's time. And so while there is the opportunity to go back to the buyer and say, I didn't consult with my lawyer before I signed this, and now my lawyer has pointed out this or that, so we need to make some changes. It's a non-binding document, but more times than not, the buyer's going to go, hey, you're trying to retrade. Come on, we had a deal. And it becomes this sort of uphill battle. It can set a negative tone for the beginning of the real work. So certainly before a letter of intent is signed, you should be working with a lawyer to help you through that. And there may be other things in advance, like helping, lawyer helping you get a proper confidentiality agreement in order. If you're going to be lifting your dress, for lack of a better term, to show the insides of your company and who your customers are and your financial information, you want to make sure a buyer is bound under a proper confidentiality agreement.
This might be thinking too much, but is there a good time of year to start this process or have a goal of when you want it to end? Because I'm just thinking about like talking to the accountant and taxes and all these things. You probably don't want to start this process like either in the middle of it or if it's going to fall in the middle of some of those things. I mean, is there a good time?
It's a really good question. There are two main things you want to be concerned about. One of them you just talked about is if you are going to be needing the account to do a lot of work for you, and you're in the springtime during tax season, you may or may not have a fully engaged accountant. That accountant might be a great person, but they're just up to their eyeballs and everybody needing him that time of year. The other one is deals sometimes are structured to close at a certain time. Year end, for instance, calendar year end or a company's fiscal year end. And sometimes it's just as simple as, hey, we just want to have a clean cutoff. It's a good time to wrap up our ownership of the business. Other times there may be a reason. So for instance, if you think back, there's been the last 10 years or so, there's been times when people either believed there was going to be a tax increase coming in, whether or not it actually did, or one did come in. And so there's this push to, we've got to get this deal closed by December 31 because if we close on January 2nd, I'm now paying a higher rate of income tax on my sale proceeds, right? So while I don't know if I'd say there's a good or bad time to do it, it's just that if you are going to be in one of these critical timing, you want to be planning far enough out in advance that you're not going to be running up against a deadline that you can't control or running up against having a service provider that's really busy and they can't give you the time you need.
And I'm assuming it's probably not wise to have a separate accountant for that. You probably want the person that's been on your accountant, if you do have one, to be helping you with that.
It really depends. And again, it goes to the competency of the accountant. I think most service professionals, we play nicely with each other. And, if you bring in an outside accountant who really is a more sophisticated person than your normal bookkeeper accountant, they'll play nicely with your bookkeeper accountant. They'll help each other. That's what we do. Likewise, I've done a number of deals where I will work with the company's family attorney or the attorney they've used on small, because they know where to find stuff. They know the history of a particular agreement that was entered into, or these types of things. So again, it just comes down to getting the right people who are the right fit for the work.
Might have to break the news to your mom. She can't be the accountant for the deal.
Well, she'll probably be needed because if she understands it, and believe me, your accountant will be part of the deal. Yeah. Hey, but as long as you're talking about financial, Garth, what does a buyer normally look at? 3 years back? Do they go back 3 years in a company? And then I know they look forward to see what it looks like. Talk about that just a little bit. What should they expect?
At a minimum, the most recently completed 2 fiscal years, and then any sort of year-to-date period or quarter ended. So right now, for instance, we're now pushing into June. A buyer would typically want to see 2021, 2022, and at least the first quarter of 2023, if not 4 or 5 months. They might want to look back further. It's a function of what's available. They don't want to put the seller through unnecessary work. If the seller, if they're, using this example, if we're in 2023 and the company's got fairly decent 2021 and 2022 financial statements, but their 2020s weren't so good, they may or may not ask the seller to go back and kind of redo those. It just depends. But I'd say 2 to 3 year look back plus current year financial information.
And what about going forward? What do they like to see? Some kind of projections of what it looks like the year out, 2 years out?
Yeah, they do. That stuff, of course, there's no typically any kind of guarantees given by the sellers on that stuff. But yeah, they certainly want to have an understanding of what they're buying.
Future looks real good.
Yeah, well,
Double last year.
yeah. I mean, and that's where things like backlog, really play in, because I've represented buyers where they've looked at a company and the numbers look great the prior year or even the year before that, but that backlog has dwindled. Recession's kicking in, interest rates have gone up, what have you. And the buyer's not buying what the company did in the past. They're buying the future revenue, future profitability. And so they need to have a good amount of comfort that what has been happening is going to continue.
From a legal standpoint, what makes a business worth less? Like, what are things that you would see that might hurt?
I would say I'll get away from the economics for starters. So things like if it looks like customers are shrinking, that's not so much the legal stuff. Risk is a big factor. If a company has any kind of a record of environmental issues, including existing environmental issues, any kind of litigation or claims, and that could be anything from, I mean, not your kind of ordinary course annoyed customer that's filed a complaint with the ROC or something like that, but real litigation. And that could be anything from external forces to internal, sexual harassment claims, discrimination claims, things that indicate that the company's not really being operated professionally and with sort of a view to just being a good corporate citizen. Tax, which is in some ways not a legal issue, but in some ways is, because depending on the nature of the business, even if it's an asset sale transaction where theoretically the tax liability remains with the seller, there's concerns potentially for successor liability or even the buyer just somehow getting wrapped up in a tax claim they don't want to be a part of. So, the cleaner the business, the better. The term we often use is, how much hair is on the deal. And every deal is going to have a little bit of hair. There's going to be some issue with an angry customer or a problem employee or something. So a buyer isn't expecting business to be clean, but the more they have in terms of sort of legal risks, either existing things that have transpired or contingencies, things that we're aware of, nothing's happened yet, but something may arise, that's going to be stuff that's going to cause the buyer concern.
And they'll look for that, huh? They go back and check.
Oh yeah, the buyer due diligence process, they will kick over every stone. They'll drive the seller a little nuts, and it's one of those things that sellers have to be prepared for. The lawyers and the accountants, the professional advisors can take a good amount of that load off, and help kind of get a hold of that information from the sellers and organize it and present it to the buyer. But that's a real in-depth process. And one of the things, this goes more on the financial side on the due diligence, is in these letters of intent, a buyer will say, well, we think the company's worth X. And so our offer is based on the assumption it's worth X. And that assumes that the company is going to have X amount of revenues this year, X amount of EBITDA, and they will do what's referred to as quality of earnings review based on the historic financial information you've provided. And it's not uncommon for a buyer to come back and say, we've really drilled down into your financial statements, and we don't really think you're worth X. We now think you're worth X minus 5. And that can be obviously frustrating for a seller who feels like, wait a minute, we had a deal, now you're gaming me.
Right.
And it can certainly be perceived that way. But that's why I said earlier why it's important for the seller to know in advance with qualified professional advisors what their company's worth, but to also be prepared for that somewhat. I always sort of explain it a bit like when you're going through that dating process with a buyer, they're going to say all the sweet things to you and want to take you to the prom, but then once you're maybe not married but engaged, then they start, the true colors sort of come through, right? So it's something you got to be prepared for.
Well, bottom line is that's kind of what they're going to do. They're going to look for it. They turn every rock to reduce that sale price, to reduce the EBITDA. That's what they're there to do.
Yeah.
Right.
So they're going to, again, it's going to look pretty upfront, and then if that's why you get things as clean as you possibly can before you go to market. So if they turn up a stone, there's nothing there, because they're going to look for ways to reduce it. End of story.
And that's not even like I'm not saying they're trying to do that. They're not trying to play games, but they have to be mindful of, they have to be good sort of fiduciaries for their own clients, their own investors. And so they don't want to buy a company only to discover that the company's not what they thought it was. So they have to do that.
Sure.
And then the other thing is, as I said earlier, with private equity buyers who make up the substantial majority of buyers nowadays, they are what's referred to as financial buyers versus, say, a strategic buyer. So if you have a company that comes along and wants to buy you and bring you into their view is, I'm buying you forever. I have no intention of selling you, let's say, in 5 years.
A strategic buyer.
Strategic buyer. A financial buyer, private equity buyer, as I said, are buying you with a view to tripling your value and selling you in about 5 years. That old real estate adage about how much you make on the property, it's not what you sell it for, it's what you buy it for. Same kind of concept here, at least in part, is the lower they can get that purchase price, the faster they'll be able to get to hitting a triple in 5 years. So they'll look for any sort of reasonable opportunity to reduce that price.
Speaking of that, are most of the sales that you've been involved in with the pool-related businesses, has that been strategic buyers, or was that more investors?
Oh, it's nowadays in just about every business, it's private equity buyers.
Why is that? What changed that?
Free money. Federal government was giving free money out for the last 20 years. So the way private equity works is they have a core group of investors, but most of the purchase price that they pay for your business, they borrow from the banks. So that you've heard the term going back to the 80s of a leveraged buyout. So it's a leveraged buyout. So let's just use an example of say a $30 million acquisition. They might put up $10 million of their own money, or maybe $8. The rest of it is borrowed money. So, which is another factor, by the way, why if they're borrowing this money and they're paying interest on that money, they want to spend as little of that money as possible, which is another factor as to why they're, going to try and, I don't want to say grind you on the price, but try and get that price down. But to your question, there are just so many private equity firms out there now, thousands of them. And they were fueled, right or wrong, good or bad. I'm sort of, I don't have a strong opinion one way or the other on that, by this very cheap money that the Fed had allowed to go out there for better part of 20 years, which of course is now changing, right? Interest rates are going up. So, private equity firms are slowing down. They're being more selective on who they buy. Whereas a year ago, they were offering multiples in the area of 10 or 11 times EBITDA for companies. Now they're coming back down to earth.
Wow.
Yeah. Well, plus two in our industry anyway, Justin, Greg, there's not too many strategic buyers that has the cash and reserves to buy companies. So that's why it's different than a manufacturer. Big manufacturers have lots of resources to do that. In our industry, there's just not a lot of that out there. I know there's one or two going on out there that are strictly strategic buyers, but very, very few in our industry. So it's always been private equity money or venture capitalists.
I see. What about going back to, from a legal standpoint, what undermines your business's value? What about, because in our business there's a lot of visa workers and a lot of employee record stuff that may not be on the up and up. How does that play into it?
Well, it'll certainly come out in due diligence. And again, buyers, they know to expect a certain amount, as I said, of hair.
Right.
Okay. So they're not expecting to find that every employee file is going to be perfect. They're not expecting to find that there's not going to be any disciplinary issues. One area that can be of concern is immigration compliance, depending on certain industries, especially where, if you recall a few years back that ICE was really cracking down on these food processing plants. I mean, because they hired a lot of undocumented workers. And so food companies were having to become much more careful about that, because when those plants get raided, they get shut down.
Right.
And so depending on the type of industry, it can be a greater or lesser risk. But generally speaking, a buyer wants to see that a seller has used reasonable efforts to determine that their workers are legal. There's no guarantees there. I mean, even an employer that does reasonable efforts, they can't give you a guarantee.
Right.
But we have things like Forms I-9, E-Verify, Social Security number checks, things like that. So if you're doing the right stuff as part of that, then buyers will be reasonably forgiving in that area.
Yeah.
Some main areas is, you're going to get, if you're a seller, one of the things you're going to get early on in the process is a lengthy list of, please provide the following documents and information. And that list is going to be anywhere from 4 or 5 pages to 25 pages. But the main things they're going to want are asset lists, not every single hammer and nail you have, but they're going to want vehicle lists, heavy equipment, lists of property, real property either that you own or lease, copies of material contracts. So that would include things like real property leases, any sort of material sort of umbrella supplier agreements. Not every PO for concrete or whatever, but if you are a pool builder and you have sort of a standard customer contract, they're not going to ask you for every single customer contract, but they'll ask for a sampling. Or they may say, hey, we want to see your contracts for any of them that have a residual cost or value to you of at least X. Employee records you got to be careful about, because there's legal confidentiality restrictions on what you can disclose, but they may want to see what employee benefit plans you have. Do you have a 401k plan? Do you have a profit sharing plan? Do you have bonus plans? These types of things, especially in an equity or stock purchase deal where when the buyer buys the company, all that stuff's going to come over. They'll want to understand your marketing program, discounts, rebates. What are you offering? What are your warranties? That's a big one in the pool business, right?
Mm-hmm.
You buy a company and you buy these 10 or 25-year warranties. That's a lot of liability the buyer's potentially assuming.
Yeah.
So a lot of the company documentation, the financial statements we've talked about.
Customer list, maybe?
Yeah, and that's one that sellers can be obviously a little nervous about.
Yeah.
It's not uncommon for a seller to say, I'll give you that, but not right up front.
Mm-hmm.
Let's get further down the road in the negotiation process. Let's get more confident that we have a deal that is going to close. And the other thing, of course, is they're not going to want the buyer picking up the phone and calling those customers, even if they have given a list or a partial list. So you'll put restrictions on that, saying you can have some customer calls and visits, but at a point in time when we agree, and by the way, we're going to possibly be on those calls. Obviously, a lot of financial and tax information. If it's an equity purchase deal, they're really going to want to drill down on the company's tax history. Want to see copies of filed tax returns, audit reports, anything like that. But I think that's a lot of the main stuff.
So what are some of the main things a buyer will hone in on?
Well, financial statements is a key thing. Material contracts, employees, in terms of what's the not just how many employees do you have, but what are you paying them? One of the things that you'll be asked to produce is what's sometimes referred to as a census, which is for every employee, give us their start date, their title, their base wage or salary, any kind of contingent or bonus compensation that they're entitled to. Are they on leave? Are they what category are they in? Are they exempt or non-exempt for overtime? Things like that. That's a key thing, especially in some states like California, where there's just so many ways to get in trouble with employment law compliance. Buyers will be particularly cautious in that area.
Have you ever had clients that want to talk to the employees
On the buy side or on the sell side?
like say, oh, we're going to buy your business. I would ask you, can I talk to some of your employees?
Sure. It's very similar to what I was just saying about wanting to talk to customers or key customers. And the answer typically is not now. And typically buyers only want to talk to management. They're not interested in the guys out in the field. Yeah, it's possible they might want to do a quick sampling just to get a sense of what's the mood, or the employee's happy or not.
I hate this place.
But they will, let's say, want to talk to the CFO or the HR director or
General
VP
manager.
sales or something. Yeah.
You want to talk to Toby from The Office?
That's right. You want to talk to Dwight. Yeah.
There's an episode all on that. I'm going to share a clip of it. It's awesome.
But yeah, that's something that the seller will want to control. I mean, one of the things that's really important early on in the process for the seller is when they're figuring out, okay, we're going to go down this path, is who do we tell within the company? Because the more people you include in that circle, the greater chance that word's going to leak. And that can become a real, it's going to affect employee morale, create insecurity. Employees may be thinking, well, I may get laid off, so I might as well start looking for a job now. And next thing you know, you're losing a chunk of your workforce because people don't want to stick around and wait to see if they're going to have a job 6 months down the road. So you really want to have a small deal team, and you really want to impress on them how important it is that word does not get out.
Man, it's such a gamble because say you tell some employees or things like that and the deal doesn't go through. Now everybody knows you're trying to sell your business, but you might not be able to for whatever reason.
Yep.
So yeah,
it's a challenge. I think most companies, from what I can see, successfully navigate that. But it's, there's things you can do. Like, for instance, when your lawyers and your accountants show up at your office, tell them don't wear a suit. Employees tend to pick up on strangers showing up wearing suits. Yeah, it's something that you got to be careful about. And
it's got to be a long 3 or 5 months, like just knowing that, your vacation, your permanent vacation's about to start, because you're getting like bought out or whatever. It's got to be a long period of time or feel like a long stretch.
I want to let Buzz speak to that because he's gone through it.
I feel like Buzz is an anomaly. He's probably like, no, man, every day one, every day.
Well, you remember that from that podcast, don't you?
Oh, of course. That's Justin chants it every day, every morning. So does Mike.
Yeah, it was I think it was for us, it was about a 6-month project from beginning to end when they first made contact. And for me, I had just told one person in the company, was my CFO, and it was just he and I for the longest time. Then it got down to where it was looking really good. Then I just brought in just the key personnel, the GM and the national sales manager, and I think that was it at that time. But I'll speak for me. It was a very emotional time. It wasn't about the vacation because I wasn't going on vacation. I was going to stick with them, which I did for a couple of years at that time. But just getting through it, and then you think about your customers and the relationships that you build. And I'm all about relationships and in and out of the business. For the employees, I was, gosh, am I doing the right thing? I don't want to let them down. I don't want to think that I'm turning my back on them. So I guess it all depends where you are in your life and where you are in your in your mindset about that. But for me, it was emotional. But we got through it and kept it a very tight knit group and got the deal done.
How did you get everybody on board? Because you had partners and everything else, right? I mean, I imagine there's some process where you got to go tell everybody, right, and make sure everybody's beating the same drum.
Yeah, you talk about stockholders or shareholders or partners. I think that's a really important thing, and I'm going to let Garth talk about that a little bit too. But that's really important before you even start the process to make sure. And I did when I first got the call or the meeting with the particular buyer. I before I did anything at all, I huddled particular shareholders or stockholders of the company. So this is what I'm thinking, this is where it's going, and making sure there was on board as possible, because all it does is just takes one to blow the deal up. So you're going to want to make sure before you go down the path of getting your business sold, if you have shareholders, stockholders, or business partners, that everyone's singing on the same page, because it can cause you problems otherwise.
Garth, if you catch it early enough in the game, you can set up your operating agreement in such a way, right, that you can force a sale or make selling with partners a little bit easier if you want to be the deciding member, right?
Yeah. I mean, operating agreements, we use that term for LLCs, limited liability companies, shareholder agreements for the more traditional corporation, but they typically would contain similar terms. And you have that in scenarios where you have multiple shareholders. So if you own your own company 100%, or it's husband and wife, something like that, it's less of a concern. But let's say you've got 5 or 6 shareholders, and you have this provision that's referred to as a drag-along provision, which basically says, hey, if a majority of the owners, or the owners representing a majority of the outstanding stock of the company, 51%, let's say, want to sell and they've got a buyer, then they can force all the other owners to sell on those same terms. You can't have one person, a 10% shareholder, let's say, holding up the show because they don't want to sell. And so, yeah, you can have these provisions in your operating agreement or your shareholder agreement that would cover you that way.
You ever get to the finish line and have a partner or a shareholder blow up the deal?
I've had scenarios where the deal could have been blown up.
Really?
And typically what I'll tell people is those provisions in your agreements are good to have, but you don't really want to have to use them, because there's always the chance that even if you exercise those rights, that person, the holdout, is going to find some other way to mess up the deal. And if nothing else, the buyer doesn't necessarily want to get dragged into potential litigation, or they don't want to be waiting for 3 months for this issue to resolve itself and delay the deal. So yes, you can absolutely paper up and have terms that will give you the tools if you need them. But the far better protection is once you've decided you want to go down the path of a sale, is make sure that your owners, your co-owners, are on board. And that may or may not be getting a green light right out of the gate. It may be just getting a sense of, yes, we think it's a good time now, subject to where you come back to us on with a purchase price or whatever the terms are. But sure, conceptually, we're on board with that.
What are some terms you can put into the deal to kind of incentivize the key employees to stay, or what do most people do?
Sure. The most common one is what's referred to as a retention bonus. And a common example would say, okay, Buzz, you're our VP sales, you're an important guy, so you stick around for at least 6 months after closing, you remain continuously employed, and we'll pay you X. And if you stay through 12 months, we're going to pay you Y. And if you stay through 2 years, we're going to pay you Z. And you're just, you're paying them to stick around. That's the most common approach.
Garth, you mentioned seeking out advice from attorneys and from accountants. Is there anyone else you should reach out to?
You don't have this in every deal, but a number of companies will, if they're on the sell side, will work with, there's different terms. M&A advisor is the most sort of generic, but people hear about investment bankers, excuse me, or business brokers. These are people that specialize in representing sellers, typically sellers, in negotiating a sale transaction, but not just sort of helping to negotiate, because that large part is a lawyer's job, but also helping them find the right buyer. And in a hot market, and what I mean by that is when you've got a lot of buyers out there chasing deals, you could be in a situation where you are a seller and you've got 5, 10, 15 different prospective buyers knocking on your door. And that's a lot to manage when you're trying to run your business. It also affects what your price is going to be. We talked earlier about a seller might have a sense of overvalue of what they think their business is worth, but it could go the other way. A seller might think, I think I can get X for my business, when in fact, working with a M&A advisor, it might turn out that you can get more, because they can get out there, they can help beat the bushes, they can help screen buyers. They have a good sense of what the market is for that type of business, and they can help the seller actually get a better deal. Sellers are sometimes of the mindset of, I don't need that, or I don't want to pay a big fee to one of these guys. But if you get the right people for the right deal, usually their fee will be taken care of by the extra money that they get you.
So in your article, you had mentioned a market intermediary.
Yeah.
Is that
Yeah, that's what we're talking about. I mean, if you think of at the sort of the top of the food chain, you're talking about sort of like a Goldman Sachs, and or one of these big investment banks, Raymond James, and then you've got at the very bottom of the heap are business brokers, who I personally don't have a lot of love or respect for. I think most of them are just not very good. They don't bring a lot of value. They're more interested in getting a deal done really fast, so they can get a fee and move on to the next client. There's one or two firms that aren't bad, but and then you've got kind of these sort of middle market advisors, and Buzz mentioned Josh's firm has a division that does this separate and apart from the accounting side. And these are really good people, very smart people, and they will take a good chunk of work off of a seller's plate. Now, there are times where a seller doesn't want it or need it. Circumstance may be where a seller knows. In fact, I had this a year or two ago. Seller knew the buyer, trusted the buyer, had a relationship with the buyer, knew in fact that they probably could get a better price if they went out to the market, but they were quite content with wanting to work with that particular buyer. Or it could be a situation where a buyer approaches a seller, and the offer that they're offering is just so good, a high multiple of EBITDA. The seller says, "Hey, this is good enough."
It feels pretty good.
Yeah. Now, I mean, even then, I'll try and say to them, well, look, if they're offering you this, how do you know there's not somebody else out there offering more? So, it's a call for the seller to make, but it's in the right circumstances, it can be a good one.
What are the majority of buyers? There's people that want to invest, and you have the private equity people. Like, what are all of them?
Buyers, for the most part, in terms of who is the party buying, there are two main groups. There are strategic buyers, which are typically established businesses already in the industry that want to add on to their business, and it's generally either operationally or economically, it makes more sense for them to add on through acquisition rather than organic growth. Or you have private equity firm buyers or financial buyers, and these are investors. Now, you're not dealing with a whole bunch of little investors. You're talking about a sophisticated financial management firm that has collected investor money and is obtaining bank financing, and then they are going to buy your company. The biggest difference between a strategic buyer and a financial buyer or a private equity buyer is the strategic buyer typically is buying for the long term. The financial buyer, the private equity buyer, is buying with a view to seeing your business, liking it, recognizing that there is potential to improve the business economically, so they can resell it in 4 to 7 years, 5 on average. I typically just say 5 years for discussion purposes. And their typical goal is to hit a triple, meaning they want to triple the value of the company in 5 years.
Which one of those usually pays more?
I used to say that strategic buyers did, and the reason for that is they've got a little more vision, I would say, a little more long-term outlook. They're willing to pay a little more now because they see 5, 10, 15 years down the road, this will be accretive to their value. Financial buyers are looking to get the best price they can up front because they want to triple that, what they're paying you, and get it back. And that old adage about with real estate, it's not what you sell it for is how you make your money. It's what you paid for it in the first place. And there's certainly some reality there in this context.
It's interesting to think that, especially in the pool space, that someone could come in like a private equity and try and triple it and sell it in 5 years, because I wonder who they'd sell it to.
Often other private equity firms.
And that's just a cycle.
Yeah.
That's crazy.
I mean, one of the typical processes is they will buy one company as their first purchase. Not the first purchase they've ever done, but their first purchase, let's say in the pool business.
Right.
And then what they're going to do is they're going to go acquire 2 or 3 other pool companies, and they're going to put them all together. So the first acquisition is referred to as a platform acquisition. And then each of these subsequent ones is a bolt-on. Those are the terms you often hear. And so to some extent, there's this idea that the sum of the whole is greater than its parts. There's efficiencies. You only need one CFO across 4 companies instead of 4 CFOs, so there'll be some payroll savings. There's simply size. Companies will attract a higher multiple in terms of purchase price based on how large they are. So a company that has $5 million in revenue and $500,000 of EBITDA is not going to get as good a multiple as a company that has $20 million in revenue and $8 million in EBITDA, right? So the idea of kind of slapping all these companies together to juice the financial results is a factor.
Makes sense.
Yeah.
Kind of hit the economy of scales
Yep.
too.
Yep, absolutely.
Is there? So I own a plumbing company in the trades. Do you find that they're looking more at like the contractors, the generals, or are they interested in trades? I feel like I get a ton of calls.
Oh, trades are huge.
Is it?
Yeah, because that's recurring business, right?
Right.
Yeah, I've sold a number of trades related, like non-pool trades related companies, and yeah, they're very popular.
Really?
Yeah.
Yeah, and I feel it's that scenario. I hear about other friends who've sold or whatever, and that's what they're doing. They're buying you, the guy next door. Like there was a garage door guy that came into town, A1, and bought all of them. As a matter of fact, I had bought doors from a company that he bought, called him a year later, it rang someone else's door, someone else's phone. So seems like, yeah.
Well, and again, going back to this idea of how try to triple a company's value in 3 years, they're coming up with creative ways to do these things. So use the example of car washes. When we grew up, you went to a car wash when you wanted to get your car washed, but there was none of this, hey, pay a $40 a month subscription and you can come in as many times as you want, right? That was created from private equity firms buying up car washes and wanting to stabilize earnings, maybe not so much here in Phoenix, but in climates where you had rainy weather and suddenly you had a week where no one was getting their car washed, right? So they said, hey, well, let's create a stabilized system for revenue generation. People pay a subscription and we know we have this kind of this money coming in. So that they will come up with things, they will do things. And that's actually, it's one thing that I know has been a frustration at times for clients of mine that have sold to private equity firms, where in the early stages of the transaction, the firm's coming in saying, we love your business, we think you're brilliant, you are the man or the woman, depending on who's running the company. We want to buy you. You've got the secret sauce. And then what do they do when the closing occurs? They start changing stuff. I can't tell you how many times I've had clients come to me after just shaking their head.
Does that happen, Buzz?
Yes, I can attest to that.
But they are looking to improve revenues. They're looking to improve profitability, and none of that's nefarious. But they have systems. These are smart people. But yeah, they're going to change stuff up.
Is there a minimum you think in revenue, in terms of revenue, that you shouldn't even try your company unless you're at X amount of revenue? Or is there a metric like that at all?
I used to say, yeah, there is. But what's interesting is, and this is probably more before the latest rate hikes in the last year or so, but private equity firms are so hungry for deals that they've been getting smaller and smaller in what they've been willing to buy.
Really?
So whereas you wouldn't typically see a private equity firm buying a company for, I don't know, sub $20 million 5-6 years ago, now we're seeing deals in the $5-10 million range.
Yeah.
Now, what those translate into in terms of revenues or EBITDA, that's again, me not being the valuation guy, but we are seeing smaller deals being done now.
Hmm.
Yeah. I would typically, though, tell sellers, if they're not in a hurry, build a business, grow it. You'll get more money if you've got higher revenues and a higher EBITDA than what you're doing if you're relatively small.
Yeah.
So is there a specific metric buyers are looking for when deciding to buy a business?
Well, I think profitability would be it. These types of businesses are not startups. Your Silicon Valley startups, which can run for years without ever being profitable, but they're growing market share and they're getting brand recognition and all these things. That's a whole other type of business than being in the trades, whether that's pool or plumbing or anything else. So, consistent revenue and consistent profitability is probably the biggest thing.
How often do you not get to a deal, or is it always some negotiation that gets you there, or do you ever just get to the end and just walk away, just can't get it done?
It happens. It's rare. I would say that in my experience, better than 90% of the time, if you get to a signed letter of intent, you'll get to closing.
Can that letter of intent just be two guys sitting at a bar? I mean, it can be, right?
Yeah. And in fact, I've had deals where the parties are working on a letter of intent, and then they just go, you know what? Let's quit wasting time with this. Let's just go. Let's just, we've talked about, we know what the ideas are, the numbers are. Let's just get right to work on the definitive purchase agreement.
Yeah.
You know, the letter of intent is a useful guidepost. It's not critical, but yeah, that can happen.
Hey, Garth, Craig asked a question a little earlier about what metric, and you kept going back just to profitability.
Yeah.
But also, could it be the technology they have and the intellectual property they have and the outlook of what it could do down the road as well? Do they look at that too?
Oh, absolutely. I mean, it depends on the business.
Yeah, exactly.
I mean, a software company is going to be looked at far differently than a pool construction company.
Right.
I was really thinking of it more in the context of,
Yeah.
there's not typically a lot of IP. There might be, maybe someone's got a groovy piece of software for pool design, or scheduling or something like that. But for the most part, these businesses tend to be more nuts and bolts. So there's less of that.
Yeah, like a manufacturer that has great intellectual property and coming out with brand new products and stuff, and they're seeing what the future could look like for that. I think they do look at that. But you're right.
Patent portfolio.
Exactly.
Yep.
Exactly. Yeah, and I get the pool builder's more of a niche side of it. But yeah.
So patent that waterless pool first, and then go for yourself.
I'll tell you, it's going to be a thing one day.
Waterless pool.
You'll be swimming in air.
Well, but those new goggles by Apple, you just put those on and swim away.
You just sell them the shell. You sell them the shell, and then you AI in the water.
That's right.
Let's do it. So how much does it cost to sell a business?
Sure, everyone wants to know.
Yeah, it's a chunk of money. Obviously, if you get it paid out of the sale proceeds, it's still a chunk of money, but it's not the same as going out of pocket. It's going to vary. Lawyers and accountants typically charge by the hour. Investment bankers or those types or market intermediaries, they typically charge as a percentage of the deal value, and that's somewhat negotiable, but just say on average, let's say it's going to be somewhere around, say, 2% of the deal value. But they only get paid if the deal closes. Okay. Lawyers and accountants like to believe that we're going to get paid whether the deal closes or not, because we're doing the work, and most times, in those rare instances where the deals don't close, it's not our fault.
Are you saying that that's the way that you guys are structured?
Yeah.
Or
yeah. I mean, unfortunately, and Buzz can attest as a longtime client, that we have yet to come up with a way, especially doing these kind of complex transactions, where we can say, this is what it's going to cost, and this is what you'll pay me. For instance, if you're doing a sink installation in a house, the sink's going to cost this, the labor's going to cost that. I kind of expect that I'm going to have to fix this pipe connector or something. So I have a pretty good sense, so I can give you either a solid number or a pretty good quote as to what the project's going to be. M&A transactions are just all over the map, and there's so many variables, there's so many people involved that something that you think it's going to take 3 months takes 8 months. Something you think it's going to take 6 months takes 2 months. I always tell people it really comes down to how well the parties play together, how efficient both sides are in getting stuff done, how reasonable they are in negotiating. So many of these deal terms are fairly standardized in terms of the term we often use, we lawyers, is it's market. What's market for this particular term? And the lawyers typically on both sides, if they're experienced lawyers, they'll kind of know what's market. So they're not going to be pounding the table asking for stuff where they know that's just not really where the market is. But you can have clients that say, well, I don't care. I want this, and I'm going to keep fighting for it, and that's fine. But I'm running a clock, so the more the client wants to kind of argue about stuff, the more, unfortunately, that's going to cost.
But you can give a typical. That's just if things ran. What can someone expect on the lawyer? I know we've talked about this with some of our other guys that you've done business. What would
so if a client said to me, okay, I'm going to sell my $20 million company, and the buyer's been identified, but we're going to do, I'll typically say, just based on empirical experience, you're probably looking around $150,000 to $200,000 in legal fees. And we do our best to come in lower, and unfortunately, sometimes that can come in higher. My goal is to have a client like Buzz, who comes to me with one deal, but I do a good job and I'm efficient and I don't, overcharge, and he comes back to me for more deals.
Yeah.
Right. So it's a very difficult number to come up with. We, at least in our case, we bill monthly. The client can see what the costs are, and if it seems like at certain points things are getting out of hand, or I'll talk to the client and say, look, just be aware this is happening and this is happening. And
so it sounds like between everybody, you're looking at $250,000 easy to maybe $5 million.
If you're working with accountants and lawyers, and I'm not even talking now about an investment banker collecting a fee, you're probably looking in the area of $400,000 to $500,000. It just depends on how much work's involved. If you've got a really good set of financial statements, that's going to go a long way to reducing, your accounting side costs. But on the other hand, if you're really not good there, then that's going to be a meaningful amount.
Even more the reason to have the house in order.
I'm sure if you're doing your due diligence and you're thinking about what you actually might lose out on if you hired the wrong company, and it might have been a little bit cheaper, but you're getting screwed out of a bunch of money over a course of time, right?
Well, and it's a really good point, because one of the things I often will tell people is, okay, you've agreed on the price. My job now is not only to make sure you get your price, in other words, we get to closing, but you get to keep that money. So, a typical purchase agreement is going to have many, many, many pages of representations being given by the seller about they have the authority to do the deal, their equipment's in good order, they've been complying with all applicable laws. Here's a list of our employees, just a ton of stuff. And again, the lawyers kind of know what's market, how that is supposed to be presented. If a seller is not represented competently, they're not going to necessarily know how they should be wording that stuff. And they could find themselves later with the buyer saying, you told me this. So an example, all the accounts receivable are collectible. Okay? That's not something you typically want to give as a seller, right? You're giving a guarantee of collectability. So buyer comes later and says, well, we assumed, as part of the assets we bought $150,000 of accounts receivable, and we could only collect $90,000. So you owe us $60,000 because you guaranteed payment. Right? So a lawyer, ideally, is going to prevent that kind of representation from being given in the first place and avoid that kind of a claim being made against the seller after.
Have you ever had anybody skip the country? They're trying to get a hold of them and they're just nowhere to be found?
No. It's funny. I was just telling someone the other day, I've been doing this now for just past 28 years. And up until yesterday, I used to be able to say I could count on one hand with fingers to spare the number of deals I've done where a buyer has come back post-closing and said, we have a claim. Meaning that the parties negotiated a fair agreement, the buyer did a good amount of due diligence so they weren't surprised by anything later, and the seller did a good job of disclosing what they had to disclose, and everything was done the way it's supposed to be done. So there is a risk there, but it's really about making sure that's sort of papered up and structured the right way at the beginning.
Hey, Garth, talk a little bit about in a deal where they have a basket where they keep money into it over 18 months or 2 years for stuff just like they're talking about, because I think that's important, that they understand that there's going to be money put aside. I think there's was it 18 months or 2 years or something? Yeah.
So there's two approaches. So what Buzz is talking about is a typical acquisition agreement. As I said, the seller's going to make all sorts of representations and warranties, or reps and warranties is the term here. And the typical approach is the buyer is going to say, okay, we're going to hold back a piece of the purchase price for, typically it's around 18 months, that timing being it gets them through one full audit cycle after closing. And that money, the traditional approach would be, it'd be about 10% of the purchase price. And it'll go into a third-party escrow in a bank. And the idea is that if the buyer discovers after closing that the seller misrepresented something or failed to disclose something, and now the buyer has a claim, third party's coming after them for an unpaid bill, or they discover the financial statements were shoddy and they overpaid for the business, things like this. They can go after the seller and there's some money in the bank there in that escrow they could go after. Not as necessarily as their sole recourse, but they at least know, if, using your example, if the sellers decided to go to the Bahamas for the next 3 years, that there's some money they can go after. The other approach, and you see this in deals that are bigger in the, say, 25 million and up range, has become more common, is what's called rep and warranty insurance. And that's where the buyer actually purchases an insurance policy. Typically, the seller and the buyer split the premium, the cost, and the premium depends on how big the policy is. Say $5 million of coverage on a $50 million purchase transaction. And if there turns out there's a breach, then the buyer looks to the policy rather than going after the seller. And instead of having to escrow 10% of the purchase price, typically you just escrow either the deductible for that policy or half of it. Sometimes the seller and the buyer agree to split even the deductible. And there's variations on that. There's exceptions to that, but that's really.
And usually there's a threshold too. They don't nickel and dime. Normally there's a point where they, if it's $2,000 or something, they don't always nickel and dime. It has to hit a certain threshold, right?
Yeah. So there's sort of what's referred to as a basket, and so what it'll say is the buyer has to suffer at least X amount of losses before they can make a claim, because you don't want to get nickel and dime claims. Right. And so you'll have that. And then what you'll also have is which is a cap, and that's saying, hey, you can never, except in certain cases like fraud, or there'll be certain representations that are identified as what are called fundamental representation. Those are things like, hey, I have the authority to sell you these assets or the stock, or we've paid our taxes, certain things like that. So subject to these certain exceptions, there'll be an agreement that says the buyer can never come back to the seller for more than X dollars, X% of the purchase price. That may be capped by what the policy is, if there's a policy, or it may be capped by some number. That percentage varies based on the dollar value of the deal, but it's generally in the range of around 10 to 20% of the purchase price.
It's like a little contingency.
Hence why you want to go to M&A lawyers, because the language is so important. As you said, his job is to get you the money and keep that amount of money. And language in a deal can take between that 18 months can take a lot of that money away if you don't write the agreement properly. What are someone thinking, sitting out there and listening to this and saying, okay, what are the steps? What do I go through to get to the point saying, okay, I'm ready?
Sure. Well, I'd say the first thing is be prepared. Get prepared. It's a marathon. It's a stressful, time-consuming. It's a ton of work. I mean, most successful business people, if they're selling a business, they've got a successful business, and they're probably already working very long hours. Okay, layer on top of that all the work you're now going to be doing, negotiating and documenting a complex transaction. It's a lot of work. And be prepared for emotional wrangling. There's going to be times whether it's you're suddenly thinking, this is my baby, I built this business, I wanted my kids to take over, whatever. Or maybe it's just I'm so fed up with that buyer, they're acting like jerks, or I can't take the extra work, whatever. I mean, be prepared for all that. It's going to happen. I've told clients on a number of occasions, eye on the prize, eye on the prize. We're this close, but don't quit now, because we're almost there. So I'd say a big one is just get in that state of mind of I'm going to do this, and that old line about how do you eat an elephant, one bite at a time. It's a process, and you got to be prepared for that up front. Number two, like we've talked about, get your house in order, and that's something. It's never too early to start. If you've got a bunch of oral agreements out there, get them down on paper. If your file cabinet's a mess, get it organized. If you've got employee compensation arrangements that are all over the map and aren't properly documented, get them documented. If you're behind on tax filings or permit renewals or anything like that, get that stuff cleaned up. The cleaner the house you have when you start the process, the easier it's going to be for everybody. And the more confidence the buyer's going to have that this is a well-run business. Get your co-owners on board with the concept, even if they're not yet signed up for the exact deal terms, because maybe you don't have those nailed down yet. Make sure that you're not going to have people coming out later, your partner saying, I don't want to sell. Or worse, I don't want to sell and you can't make me. Figure out who your deal team's going to be, both internally and externally. You want to have as few people inside the company early on as possible knowing about it, but you're probably going to need to have one or two. Externally, as we've talked about, get qualified people to help you. If you don't know who they are, ask around, ask for referrals. Most people will be more than happy to give a referral. And if you get a referral, ask them questions. Ask them what their experience is. That type of a deal, the industry you're in. You want to make sure you got people that the right fit. Make sure they've got the bandwidth to help you. Business service providers love bringing in new clients, but you want to make sure that if you've been referred Joe Smith at X firm, that because that's the guy, that you're actually going to get Joe Smith and not some third-year associate that's going to do most of the work. Those are probably kind of the key things kicking off.
One thing that comes to my mind too, maybe is you said it earlier in the podcast is come to some kind of understanding of evaluation early on.
Yeah.
Don't have expectations of something that is way out in left field, because I think that can derail a lot of situations. Or you're going to go 9 miles down the road thinking something and it's not going to be there. Get to that number that you really think is realistic, that the market is marketable, and get that number. And if that's good and you like that number and it feels good, then go to these next steps. But so many people have, and again, it's the typical entrepreneur, the blood, sweat, and tears. We all think our business is worth probably a lot more than the market is. So get to that, and the right people and team will help you with that. And I think once you get to that threshold and say, okay, I get it, I'm okay with this valuation, then you start moving in that direction. Does that make any sense?
No, absolutely. Yeah, absolutely.
What about, let's say you want to sell, where do you go to try and find a buyer? Like if you don't have a buyer knocking on your door or something, what would you suggest?
It's a good question. Right now, these days, most people don't have that problem because their phone keeps ringing. Someone wants to buy them, or they've got some intermediary who claims they've got a buyer, which may or may not be legitimate. Mm-hmm. If you're ready to sell and you really don't have a sense of a buyer, you've really got two paths. You've got whatever your own network is in your industry. So you might know companies, and there's no harm in picking up a phone. And obviously, you want to try and have that conversation confidentially. Otherwise, engaging an M&A advisor. That's a big part of what their job is, to go beat the bushes and find you a buyer.
And they put together a great deck. They get all your financial information, and they disseminate it to all over. I mean, they know the contacts, but go to them first, and they bundle up in a nice package so it's easily readable for someone and understandable for someone, and then they disseminate it. That's the best thing that you can do if you don't have anybody.
And they will be a good reality check for you too, because of the fact that they're only getting paid if they close a deal. They're not going to want to waste time with you if your business is a mess or it's not worth that much or whatever. So they will themselves will be a bit of a reality check for you. Now, again, there are different tiers. If you get a decent middle market M&A advisory firm, they will do all of that right. You get these smaller business brokers, they'll say, I can sell your company, and they'll ask for a small retainer up front, and then they'll just blast out your details on some internet chat board and never do that much else. I really don't want to disparage the entire business broker community, because like I said, there are a couple of decent firms, but you guys got to be really mindful who you engage. You want to make sure whether that's lawyers, accountants, whoever, you want to be making sure you're working with the right people and they're there to help you.
I think this was all really great information. I think everybody listening is going to take a lot from this.
Yeah, same here. This is a question I've asked multiple lawyers.
Yeah.
And I want to know, what is your favorite lawyer movie of all time?
I thought you were going to ask my favorite lawyer joke. Favorite lawyer movie? Huh.
That's next.
Okay.
There's so many.
I can't think of a single lawyer movie.
There's so many good ones.
I got to say A Few Good Men. I mean, that's one of those ones, no matter how many times you're flipping around the channels, you see it, you start watching it.
He's thinking My Cousin Vinny, I know it.
Well,
I actually like
that's
Rainmaker.
A great one too. That's a great one too.
Rainmaker, that's my favorite. That one's so good. But My Cousin Vinny, it's a classic.
That one is classic.
Classic, yeah.
I'll show my Perry Mason.
Perry Mason.
I don't even know what
that was. You don't even know what the TV series Perry Mason?
I don't.
Damn, Buzz.
What year is that?
1950. No. Well, it was, I think.
That does sound familiar. I can't say I've seen it.
Oh yeah, there was. You really know the old Perry Mason.
Yeah, I mean,
That goes way down. I'm showing my age.
it predated me, but I at least knew about
It
it.
didn't predate. I want to just say one. I want to end with one bit of advice if I were to leave this podcast with for a pool builder. I always say, and I did a whole thing at I think at Pace or done seminars out there. Run your business as you're going to sell it every single day, even though you're not. If you run your business like you're going to sell it tomorrow, you're going to be doing all those things that Garth just talked about earlier, getting it prepared every single day. So when that time does come, whether it's 1 year, 10 years, or 20 years, you're prepared. So just have that mindset that you're going to be selling the business like you sell the next day. Make sense?
I love that.
Love it. Well, thank you both so much.
Yeah,
Appreciate your
you bet.
time. This has been amazing, and look forward to talking to you guys again.
Absolutely.
Thanks, guys.
Fun.
Thanks bunch.
Thanks, guys.
Thanks. Yep.